Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com comments on the volatile markets, gold, silver, crude, and the Canadian dollar. Victor Adair from PI Financial in Vancouver talks about what's behind our very bouncy markets and how the relatively new head of the U.S. Fed appears to be his very own man. Canadian home ownership consultant Ross Kay examines the dramatic drop in the value of Canadian real estate. He says the loss may be much more severe than official sources would have you believe. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the Pink, symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to the new year.
Yes, pleasure to be back with you, Jim. And we're off to, as we finish the year, very volatile, lots of day-to-day fluctuations here.
Wow, numbers that we probably haven't seen or not seen recently. One day down dramatically on the Dow, the next day reaching for the sky again. What's going on?
It's just a matter of who we're listening to on any given tweet, or as it would be on Friday morning. A combination of the Chinese coming out with a change in their reserve requirements, which making things good over there, at least for a bit of a push to the market, followed by the employment numbers both in the U.S., big number there, and then the Canadian ones, another one doing well. And on top of that, a few hours later, you got the head of the Fed, Jerome Powell, saying that they're not fixed in stone. The comments about at least 2 rate cuts this year and possibly more into 2020, clearly backing off on that the way they should be. I mean, they've always said in the last number of years that they want to be data dependent. Well, if you're going to be data dependent, don't give us a forecast out at a year and a half. Let's take a look at what's going on a month by month basis. So the market like that. You've got a 700-point move on the Dow to finish off the week, and it's interesting. We came from such depths of pessimism here just in that last few days before Christmas. The 24th, we got capitulation readings in the stock market. We got it in the oil market, and here we are with a fair amount of volatility. And, we're finding, and once you've had a break as hard as we've had, it's normal to go into a consolidative phase because you now just got to prove, was this just a first leg or another leg down in the market, or is this going to create a base from which it can consolidate and move higher? Well, the key levels that we would look for, the first rally should have retraced 38% of the break from the November highs, and we did that right to a T. And we settled back into Thursday, and now we're having a secondary rally. Now this one, you would expect to now retrace a full half of the move down from the November highs, and 38% from the all-time highs. So as far as the S&P is concerned, we're looking for 2575. I think is a pretty reasonable target on the rally that started Friday morning, and we'll see how it caps out there. That will be the telltale. And the classic comments that how January goes so the market. So time will tell on this one.
What's the outlook for gold? Is it going to continue to rise?
Well, It's had a great move off the not only just the summer low, but more recently the November correction. And as of the last 48 hours, we've got some good upside exhaustion signals. Now, this doesn't mean it has to be the end of the move, but it means that momentum should now start to diminish. Because we've run so far so fast. We kissed just over $1,300 overnight, Thursday night, Friday morning. And not only is that a psychological level, but also the fact that we're so overbought. What we want to make sure of here is that the pause that we have doesn't start to really not only just lose major upside momentum and just become sluggish, it's that it doesn't reverse. So we're looking at 1279 on a closing basis as the important support for the gold market right now. If it breaks through there, then you want to be looking for a decent correction, probably back into the 1240s, that type of move. So for traders, they probably want to have tight stops. The mining stocks, the precious metal stocks, have been performing very well in December into right into the end of the year, but they're looking a little tired right now and need a pause as well. Now, the other precious metal that you want to keep an eye on is the silver market. That one, good oversold signals out there in October. We got the November reversal to the upside, and the weekly charts have now, they've gone overbought for 2 weeks in a row. But this could actually, if it continues to stay relatively strong, this overbought can be read as a sign of strength, not just an overbought in a downtrend. If it manages to hold up here for another 2 weeks or so, then clearly you want to be a buyer of dips rather than thinking about selling the rallies.
The Canadian dollar, how's it doing?
It likes what's happening over in the oil market and what's happening with this rebound in equities. The dollar managed to tack on a good cent and a half in the last 3 days. So we're not seeing any divergences against the oil into the bottom, which would have been very, very bullish. So this is more just a recovery with other commodities and with a weaker U.S. dollar. U.S. dollar as a whole had a poor week this last week. The index closed around 95.78. That a week and a half ago, I'm up at 97.5. So it's the U.S. dollar's run out of steam here. Canadian dollar gets the benefit out of that, and the commodities get a benefit with oil having made a great move. I think we closed over $48 for the first time since the middle of December. And I think the 52 level still continues to be, I think, an important resistance level. The big picture is that 10-year cycle was due to bottom fourth quarter of last year, first quarter of this year. So the first month with a higher high, and that's going to take a bit to happen. Probably, if it's going to be anywhere, it's going to be out in February, March. But first month with a higher high, and I think the oil's got a pretty good potential on the upside.
Ross, thank you so much for being on This Week in Money.
And looking forward to a prosperous year for everyone.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, Victor Adair next on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the pink CYDVF, and on Frankfurt C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. My guest is Victor Adair, co-founder of the Polar Futures Group. He's Senior Vice President and Derivatives Portfolio Manager at PI Financial in Vancouver. His website, polarfuturesgroup.com. Welcome back to This Week in Money, Victor.
Well, thank you, Jim, and Happy New Year to you and all of your listeners.
Victor, what a volatile market we're looking at right now. All the U.S. major stock market indices made all-time highs in early October. And since then, oh my God, there are roller coasters in the world that would be jealous of the ride you would have gone on. What's behind the bounce back that we've seen recently, and will we see more of them?
I think, obviously, that's the $64 trillion question. From this perspective, if the break that we've had from October into the Christmas lows was just a correction in an ongoing bull market, I mean, we had a 20% decline in both the Dow and the S&P from their all-time highs that they made in October, then that could be it. I mean, it was a pretty dramatic blowout at the bottom of the market there around Christmas time. If you take the view, as, say, David Rosenberg does, and I really respect David Rosenberg, that what the market has been sniffing out here is a recession dead ahead, then the price action that we've had here, this is would be the first leg down, and we probably make new lows. Or according to him, we would make new lows as we go into the rest of the year. Global markets all topped out back in January, February of last year. The U.S. market broke down with the rest of the world. But then as the rest of the world continued lower throughout most of the rest of the year, the American markets rallied back from, say, April right to those October highs. The lead on that was a handful of big name stocks. Certainly the FANG stocks were there, while the rest of the world kept going down. In that environment, capital was flowing to the USA. Remember, we had tax cuts, fiscal stimulus, let's call it that. The capital flowing into America, as I like to say over the years, for safety and opportunity, had to go somewhere and was going into big cap stocks for sure. The capital flowing into the United States strengthened the U.S. dollar, so you kind of had a double whammy of the U.S. stock market going up, and in, foreign currency terms, it was really going up. So again, a great magnet for capital to come in and push it up. So in that sense, maybe the U.S. stock market got too high as we went into the October period, while, the rest of the world stock markets were correcting lower. So from a too high perspective, then, you could see the correction that we had October to Christmas time was that much more necessary, or because things have been too high, the stronger they are, the harder they fall, all that sort of thing. And then partway through December, we had the Federal Reserve come out, a scheduled meeting, and there had been hopes, ahead of time, that they might not raise interest rates. Well, they raised interest rates, and the thing that really kind of socked the market in the eye was Powell saying, and by the way, the running down the balance sheet, that's on autopilot. So partway through, or midway through December then, on the 19th, that Fed action kind of accelerated the market decline, and it took us right down into the lows. Meanwhile, from the possible recession perspective, as Rosenberg would talk about, he had major sectors of the U.S. economy certainly were showing signs of slowing. That's like autos, housing, energy, the ISM index, that sort of thing. So we've had this manic price action, as you just referred to here, especially, I think, once we broke below the lows we made last February. Once that happened, it was like, oh my gosh, we really are going down. You had something like $85 billion worth of capital come out of mutual funds and ETFs. This is basically folks calling up their broker and saying, get me the hell out of that stuff. I mean, I get my month-end statement here. I can't believe what's happening, you know. So maybe a capitulation low. We've certainly had a significant low, 1,000-point rally on the Dow on day after Christmas, and then a big day up here again today. We'll see. I'm going to be a trader. I'm going to play it the way it goes rather than say I know what's happening and put a lot of money at risk and just hope I'm right.
Markets are paying a lot of attention to the Fed. It seems that the December 19th Fed rate hike and Powell's comment about balance sheet reduction was on autopilot, hit the stock market hard when it was already falling. It contributed to the Dow falling another 2,000 points or so. You told us before that it's a new Fed under Chairman Powell. Do you think that's still true? And even as we speak, he put out a statement saying if he's asked to resign by the president, he won't do so.
Yes, it is a new Fed under Powell. Under Greenspan, under Bernanke, under Yellen, the market had reason to believe that there was a put under the market. In other words, if the stock market was to take a tumble, the Fed would ride to the rescue, to use that colloquial language. And I think the market's getting a message now that maybe no, from Powell. So it's a different Fed. I have to say, and this is just me personally, I watched him on television today. I've watched him before. I like this guy. He's so practical, and particularly today when he was on that panel in Atlanta with Bernanke, with Yellen. I mean, they look so, bureaucratic, academic, and Powell just looks like a real, practical guy. He's short and sweet, spits it out. Now, today he did indicate, it seems, that if circumstances warrant, they might just reduce the amount of runoff they're having in the balance sheet. And the market just loved that, just like they hated hearing him say it was on autopilot back just a couple of weeks ago. So that was one of the reasons the market, I think, ripped higher today, as well as, we've had this terrific sell-off, and people some folks anyway, are looking for an opportunity to buy because they think it's cheap. So to get to your question, Powell is a different Fed chairman. It's a different Fed now that he's in charge, and the market's having to come to grips with that.
Well, the stock market was falling. The bond market had a strong rally. Is that just a case of people moving their savings from the stock market to the bond market?
Yeah, that's part of it for sure. And that, for years and years, I'd say for decades, there's been this balancing act in people's portfolios where the theory is, if you own some stocks, you should also own bonds, because if it happens that stocks fall, then bond prices will go up. There's a balance there. And we have seen, as I said, $85 billion or something flow out of stock mutual funds and ETFs, and there's been something considerably less than that, but there's definitely been a capital inflow into the bond market. So there's been some of that. And then, just as I was saying, stocks maybe got too high back in October. The bond market prices may have got too cheap, or yields were too high in October. Say, as we went through August and September, the bond market was taking a tumble as stocks were going up, as U.S. dollar was going up. So we may have had some of that too, where the run in the bond market had been overdone. But then turn it around the other way here. Certainly since the beginning of December, the bond markets have been screaming higher, yields falling like a stone. And that may in part be because the bond market is seeing a recession ahead. Again, go to Rosenberg on this with these weak sectors in the economy. And some of the things that are strong, like the very strong employment report we got today, that would be sort of a late inning in the ball game indicator. In other words, you're going to see really strong economy just before the market starts to the economy starts to weaken. So perhaps bonds seeing a recession ahead, and that's why they've been going up while the stock market's been going down. Could be.
We'll have more with Victor Adair when This Week in Money returns.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Grand Portage Resources recently completed the 2018 drill program on its 100% controlled Herbert Gold discovery property located in the prolific Juneau Belt in southeast Alaska. Drill results are expected through late 2018. Past drill results included numerous multi-ounce gold assays on multiple veins. Grand Portage trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Victor Adair. Victor, you've been bullish on the U.S. dollar most of this year. What do you think about the U.S. dollar now?
Jim, honestly, the last few weeks, maybe not a month, but 3 weeks anyway, I've been wondering if the U.S. dollar was starting to roll over. Just take a look at history here a bit. The U.S. dollar trended down from, at least decade highs that we'd reached in January of 17, all the way into April of 2018. And then from around April of 18 right through November, we had a very strong U.S. dollar. A good part of that was because of what we call the divergent interest rate policies or central bank policies. In other words, interest rates were high and rising in the United States relative to other countries. And that caused the U.S. dollar to rally, but especially against emerging market currencies, what I call the stealth strength of the U.S. dollar. Emerging market countries, that had borrowed U.S. dollars and were exporting maybe into U.S. markets that were particularly vulnerable. And we also had this capital flowing to the USA for safety and opportunity, as I mentioned when we were talking about stocks, and that got U.S. stocks outperforming stocks in the rest of the world. But as the past couple of weeks, I've been wondering if maybe the bloom's off the rose a bit with the U.S. dollar, and I was thinking to myself, so if the U.S. dollar is going to roll over, what would I want to buy against the U.S. dollar, and what might be a catalyst for that to happen? And usually there's some trigger point or some news item or whatever. And increasingly, as I would look at what we call a chaos in the White House around Trump, I mean, people leaving left and right, it seems. The Democrats getting control of Congress, the Mueller investigation going on. I was wondering if that might cause people in the rest of the world to say, stop sending money to the United States, maybe say, send some back home again. Certainly seeing that with the Japanese yen, capital flowing to Japan. But then I look at the whole European scene seems kind of a disaster. I mean, it's, Brexit or Merkel stepping down in Germany. Macron's having his trouble. He looked like he was going to be a good guy, and now he just can't seem, he's like got the tar baby in his hands. So euro didn't look that good. Anyway, cut to the chase. What I did decide on was I thought gold looked good if the U.S. dollar was going to start to weaken, and in fact that's played out. And we maybe talk about gold a bit more later.
The Canadian dollar made its highs for 2018 in January at around 81.5 cents. Now it's been down as low as 73.5 cents in the past week or so. What has the loonie falling, and do you think it's going to keep going down?
Yeah, those highs that Canada made, interestingly enough, back in January, February of this year, came just at the same time that the global stock index or an index of global stock markets was making its high, as the U.S. market was making its highs at that time. And then as the stock market peaked and rolled over, so did Canada. So Canada had a very interesting correlation to a falling stock market. It was kind of like if you got a risk-off environment, stock market's going down, so is Canada. Then the most recent high we had here in Canada back in early October, that occurred just as U.S. stock markets were making all-time highs and rolling over, and also as crude oil was making a 4-year high, or $76 on WTI. So then through October, November, December, as the stock market and crude oil trended lower, Canada was going down with them. And then the decline here in Canada, let's say certainly, November into December, we had Canada closing lower. 12 of 13 weeks were down a total of about 5 cents. Now, this week, Canada, let's say way oversold, has bounced about a penny and a half off the lows. We've got a weekly key reversal up on the Canadian dollar. But wouldn't you know it, here's Canada rallying while at the same time U.S. stock markets and WTI are both going up. So there's real strong correlation there. Over time, as we've talked on the show before, the things that Canada pays attention to, and the Canadian dollar foreign exchange rate, the relative strength of the U.S. dollar. So typically, if the U.S. dollar is going up against most other currencies, it's going up against Canada. Commodity prices are really important, particularly crude oil, obviously. And then the last thing is the interest rate spread with the United States. And, going into the fall here, particularly as crude oil prices are going down, you hear people, let's say, talking more and more about real estate prices weakening in Canada. In that environment, the market's thinking, no way, Jose, is the Bank of Canada going to raise rates. So then they're falling behind the Federal Reserve, which seems determined to keep pushing rates up. And that was just another nail in the coffin as far as the Canadian dollar was concerned. Going forward from here, again, if it's tied to the stock market a lot, tied to the global economy, commodity markets, if the bounce we're having here since Christmas time is just a little bounce and the stock market goes a lot lower, I think it's going to be tough for Canada to do better. If we just had a blowout here for a couple of months and the stock market can gain its footing, get going again, crude oil catches a bid, then Canada's higher as well. Right at the moment, I don't have a position in Canada, so I'll just, and I've been, just bearish on Canada for years. And for my long-term positioning, I remain defensive there. But my short-term accounts, I don't have a position in Canada. I'll just watch and see which way it's going.
We'll have more with Victor Adair when This Week in Money returns.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Victor Adair. Victor, gold has rallied about $70 since the beginning of December. Why do you think that's happening, and do you expect that rally to continue?
Well, gold is really, really sensitive to the U.S. dollar. Gold made its highs for last year. It's hard to say last year when it's only a couple of days into this year. But for 2018, our highs were around $1,360 back in the January-April period. And then as the U.S. dollar started to rally beginning in April and going through the summer, the gold price fell. I think we had gold drop about $200 from April through midsummer or August thereabouts as the U.S. dollar was going up. And a really interesting thing also happened in that same period of time, and that was we measure how different kinds of speculators, different kinds of traders in the futures markets are positioned. So we saw this summer, for the first time in well over a decade, that speculators were actually net short gold for the first time, as I say, in 10 years on the futures markets. And that was, I think, It's like a perfect case of who needs gold, when the U.S. dollar's going up and the stock market's going up. And of course, as a sort of a contrarian-minded trader, I was looking at that and thinking, okay. So then as we saw the U.S. stock market falling in October, beginning in October, gold started to catch a bid. But interestingly enough, at the same time, so did gold. So you had, the U.S. dollar. So you had the U.S. dollar and gold both rising a bit at the same time. But where gold really started to roll here was in December when we were up $70, $80, as the stock market was really starting to fall and the U.S. dollar was sort of sideways to lower. So, and I mean, not surprising, by the way, to see today gold, we just had this great run here, $80 or so. Setting back a bit as the U.S. stock market is doing so much better. So gold so tied to the relative strength of the U.S. dollar. It's caught a bid, obviously, as people were worried that the stock market was really getting hit hard. But you're asking. Those are the key things I think that have pushed the price of gold. Where we go from here is going to be very much a function of where the stock market and where the U.S. dollar goes.
West Texas crude hit a 4-year high in early October, around $76. At Christmas time, it was below 43, a drop of about 43%. Crude has since bounced back a bit, but what do you think is going to happen with crude?
Yeah, crude, let's start with this. At the highs, at the late September highs, I at the time was writing about that crude oil was too high. And it was too high because there was a lot of thought that the American sanctions on Iran were just going to turn off the taps in Iran. And there was going to be 1.5 million barrels of export crude just come off the market. Well, as we know, the Americans watered down the sanctions, and then at the same time, you started seeing dramatic production increases from OPEC, and by that we mean Saudi Arabia in particular, Russia, and the United States. While also at the same time, demand estimates were falling. So the market just had this huge swing in a very short period of time from fears of being undersupplied to fears of being way oversupplied. So we had a terrific fall in the price of crude oil in the course of 3 months or so. And I think that the weak stock market, by the way, the falling stock market prices added to the pressure on the price of crude coming down. So here we are down here. We bounced a couple of bucks. I think we've got up to maybe $48 or so in front month WTI. I've been watching a lot of the energy stocks and energy service stocks, and I mean, a number of them, majors, have traded below where they were back in January of 2016 when crude oil got all the way down to WTI, that is, got all the way down to $26. Like the energy and energy service sector has just been clobbered. So capitulation lows, it looks more like that to me in crude, like $43 was a low, and things that have to get pretty miserable to take that level out again. And of course, my good friend Joseph Schachter, who has forgotten more about what's going on in the oil markets than I've ever learned, Joseph sees crude oil rising here over the next few years. Now he's got a much different time frame than I have, but I think the $43 low looks pretty good in terms of a low. Things that have to get pretty miserable for the market to trade below that.
There's all this talk of electric cars, but do you think it's going to take decades before they really have an impact on the crude business?
I'll give you Joseph Schachter's short answer on that, and that is if there wasn't a whole bunch of electric vehicles out there, crude oil prices would be $150. So it's like we need electric cars to keep some kind of a lid on crude oil prices, and I just think that's a great answer. And for sure, there's going to be more and more and more electric cars in our future. And Joseph, again, says the big demand growth area is going to be India. As we all know, the population in India is getting to the point where pretty soon they're going to be the most populous country in the world. They use hardly any oil. compared to other countries in the world. They're going to start to demand more oil, and the demand that they're going to have, if it wasn't going to be for electric cars in their future, would really push oil prices a lot higher.
Victor, before we wrap up, can you give us some examples of how you make trades based on your market ideas?
Yeah. Okay. So I guess, well, the first thing I'm trying to do when I'm trading my own money in the market is I'm trying to make money, not prove a point. So part of that is managing risk. I mean, managing risk is just the most important thing to me. And managing risk, I can do that by adjusting my position size, the time frame that I use, and definitely every time I put on a trade, I'm prepared to be wrong. But what that means is, okay, let's say just as an example, I'm going to buy gold here because I think the gold market's going up, even though I just sold it on Wednesday. Well, the first question I want to ask myself after I've worked out in my mind that I think it's in a bull market, I say, well, if I'm wrong, at what point do I have to throw that position over the side? Where am I going to draw the lines in the sand? And when I figure that out and I calculate out how much money I would lose if I have to wait for the market to get to that point, I said, nah, I don't want to lose that much money, so I'll just pass on the trade. As my dear friend Peter Appleby likes to say, there's a rumor going around that the markets will be open again next week. So if you can't find a good spot to get a trade on this week, don't do it. Don't break your rules. Just wait for the right setup. And as we've talked quite a bit today here, there's so much concentration in the market. You got to watch that, for instance, just a real casual example, if you are long on the stock market and short on the bond market, it's the same trade. Like you've just doubled the size of your trade. You haven't diversified at all. So there's so many ways here where there's concentration, and you'd say that if the market gets into a risk-off mode, then it becomes very binary. So it's everything's going one way or everything's going the other way, and you got to watch that concentration. Here's another one. I think trading's really opportunistic. You can't make money just because you want to. The situation's got to be there, and sometimes, what you need to do is nothing. Just wait for the opportunity that suits you. And here's another one in terms of being honest with yourselves. I mean, I know I like to call BS. What that would really mean in plain language is if I see a market that's just racing away to the upside and I think it's way, way, way overbought, there's part of me that just wants to sell, get out the pink tickets, hit that thing. And because I recognize it in myself, if I see that happening, I'm getting impulsive and I want to do it. I try to train myself to just wait for it to break first. I remember interviewing Bill Fleckenstein in Seattle years ago, and I said, so Bill, introducing him to my listeners on the radio, you're a short seller, so you like to sell stocks that are way overvalued and then buy them back after they fall and you make your money that way. And he said, no. I do not sell stocks that are way overvalued because they can get way, way, way more overvalued. I need to have a good reason to think the stock market, that stock, is already on its way down. And I thought that was just great advice. One last thing, Jim, and that would be probably the thing that's made the biggest difference in me being able to trade profitably instead of just throwing money around, is I write it down. I write down why I'm doing something. I write down where I'm going to get out if I'm wrong, and then and I go back and read my notes. And that all by itself kind of keeps me from being impulsive and makes me I'm going to say it makes me a better trader, but it certainly makes me more it allows me to rein myself in, so I just don't do things on the spur of a moment.
Victor, can you tell us a little bit about Polar Futures Group?
Yeah, Polar Futures Group is my son Drew Zimmerman and I. Drew's now been 6 years in the business, working with me, and he's and certainly working on his own. We are both of us are derivatives portfolio managers. We're also both stockbrokers and commodity brokers. And, we have clients like other brokers, and then we have managed accounts where people give money to us and we trade it on a prescribed managed program as well. And then over the years, I've also done a lot of what I call corporate risk management business. And these days, Drew and I talk every day, compare notes about what we see in the markets, and decide what looks like a good idea and what isn't. And we trade independently. I think I just can't imagine, even with my own son, it's hard to trade as a committee. I think we do each other a lot of good by bouncing ideas off of each other, but you have to make your own individual trading decisions, and that's how we do it.
Victor, thank you so much for being on This Week in Money.
Good to talk with you, Jim. Look forward to doing it again.
My guest has been Victor Adair, co-founder of the Polar Futures Group. His website, polarfuturesgroup.com. Our conversation took place on Friday. Coming up, Ross Kay and everything real estate, next on This Week in Money.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMY.Resources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with home ownership consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to the show, Ross.
Thanks for having me back, Jim, and Happy New Year.
Ross, is a credit crisis forming in Canada and around the world?
A credit crisis. I'm not going to say that there's a credit crisis forming, Jim. I think with how we look at things, we look at the ability of consumers to access credit, and we don't look at it from a perspective of credit being withheld from them or problems with their ability to repay what they borrowed. You have to look at Canada. When we're talking about Canada as a whole, and you have to look at it over the last 50 years, and Canadians are very prudent when it comes to repaying their debt. And although, we're always going to see a few foreclosures that happen in a housing correction, you're always going to see people selling their houses and downgrading to the size of house that they're in. Very, very few times is a crisis ever going to be created by it. When we're discussing this, the easiest way usually is to discuss it. We look at it from the perspective of a mother. When you sold houses to thousands of families and you've dealt with thousands of mothers, what you find is that that side of a family, they are ruthless when things get tough. They have the ability to do anything to protect the family, protect the family's interests, protect their kids. And in these situations, the car will go, the boat will go, the trips down south will go, the credit cards may go into arrears. But that house is saved at no matter what. And generally speaking, Jim, it is the female side of a marriage that drives this conversation. So when we talk about a credit crisis, remember what we're talking about is your ability to access credit. And when you have economies that are built on growth, the same as if you have a business that is built on growth, instead of sustainability, then you're always going to have a crisis because growth can't go on forever.
If credit is constricted, does it matter where interest rates are headed?
No, actually, it's actually just the reverse. So we believe, and our data would support the way that we read the data that we have is that interest rates themselves is what constricts credit. So it's the interest rates as they rise, and the borrower has to spend more money each month on interest versus repaying the principal, paying off the debt, that actually makes it look like the credit itself is being constricted. The only thing that really constricts credit is your income. How much money do you make, which universally lenders from across Canada, around the globe, have a certain amount of your income they will allow you to spend on borrowed money. There is a number for that. When you come up against that number, interest rates jump. Sometimes astronomically they jump because no one wants to lend you the money. There are always profiteers out there looking to do it. There's always people looking to make an extra gain in your money. But generally speaking, you get up against that wall and it's over. You can borrow no more. Interest rates are that wall. The interest portion of your debt repayment, as it increases, the amount you can borrow decreases. It's always been that way, always will be that way. That's just simply a fact of life.
In 2018, Vancouver saw the lowest home sales in the past 18 years, even though the population increased. More homes have been built. Is that the result of tightened credit or ridiculously high prices?
Well, what every housing market has, it reaches a point of exhaustion. And there's a group out your way called Generation Squeeze with Paul Kershaw, an academic who's at the head. I told him back in 2015 that the easiest way for the group he was representing to get lower house prices was for them to quit buying. Because when first-time buyers quit buying, housing prices drop, which is exactly what you are seeing across the board in British Columbia and Ontario right now. There were not enough first-time buyers entering the market to sustain the market. You saw disproportionate increases in condominiums prices during 2017 in British Columbia because there was that $37,000 boost to first-time buyers. When that's removed, prices automatically drop. When first-time buyers leave the market slows. We are not bringing in enough new Canadians. The population is not aging quickly enough. In other words, 18-year-olds are not becoming 27-year-olds quickly enough to sustain housing markets in perpetuity. That's why they're cyclical. That's why there's a trading cycle. That's why our forecasts are always accurate. We understand how the home trading infrastructure works. We measure the different parts of it, and we know what's going to happen. It's why we're never wrong. It's not that we're arrogant in this statement. This is the reason the sky is blue, the reason there is the grass is green, is exactly the same way housing markets work in the cycles they work in. First-time buyers leave the market is exhausted. The market collapses. What's unusual is when policy changes continue to constrict what buyers are buying in a marketplace in such a manner that they're constricting it towards the wealthiest of each class of home buyer. Since they're the wealthiest of each class of home buyer, the average selling price increases. Benchmark prices increase. HPIs increase. House price illusion increase. That's the only way that you get a 30% house price gain year over year in 2016 in Vancouver and year over year in 2017 in Toronto. It had nothing to do with house prices. It's just who was buying in those months. You're in an exhausted market in Vancouver right now. There's going to be a period of recovery. This period of recovery is what's called a housing correction, and you're just going to have to grin and bear it because these things are simply fact. You cannot avoid them, no matter what an economist, no matter what an academic, no matter what a politician tells you. You cannot avoid these normal, historically proven, for decades, well, centuries, I guess, facts about a housing market.
We'll have more with Ross Kay when This Week in Money returns.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2 AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Ross Kay. Ross, are bankers afraid of a household debt bubble in Canada?
The banker CEOs, I think there was a report this week, Jim, that in the first half a day, by noon on January the 2nd, I think, maybe they don't count January 1st, bank CEOs had earned more than what the average Canadian earns in an entire year. So, like within 6 hours, they're paid what the average Canadian earns in an entire year. It's really a phenomenal number. The reason they're paid that, in my opinion, is because they provide profits to the bank and to their shareholders. The higher the profits they can produce, the higher the remuneration they're going to get. It's called growth, profit growth. What happens in a housing market is that the housing market slows, and that revenue generation is no longer happening. Banks adjust to that very quickly. Historically, for the last 40 years, how they adjust, well, not the last 40, the last 25 years, because mortgage discounts really only came into play in the late 80s, early 90s. Banks would adjust their mortgage discounts to steal business from one another. That's how they would do it. A bank would make a determination that we're going to get as much new mortgage booked on our books as we can, because that just drives our profits. This time around, the banks, as we have stated earlier on our House Street interviews, Jim, the banks used B20, the B20 regulation. And they used it strategically exactly as we warned that they would do. They have reduced their mortgage discounts. They are squeezing their existing mortgage clients now to raise the profits at the bank. Bank CEOs would lend Canadians double the mortgage debt that they have right now if the government would give them access to that money. CEOs could care less about Canadians. They could care less what you do. As long as you meet the qualification to get credit extended, they will capitalize on it. What the problem we have, Jim, is that this society, for some reason, doesn't understand realtor greed, banker greed, greed for anyone in these service sectors, which who make a profit by getting Canadians into deeper and deeper into debt. This includes mortgage brokers. You need to be getting advice so that you can go to these different people, the banker, your mortgage broker, your realtor, with specific instructions before you get there. These instructions stop those CEOs at the banks from squeezing you so that they can make your income in the first 6 hours of the year.
Who's more likely to give you a better deal for a mortgage, your local bank or a mortgage broker?
Okay, so my firm believes every single Canadian should pay a mortgage broker for advice. That is what my firm believes. Every strategy that we have involves a mortgage broker, but not allowing the mortgage broker to go out there and source the mortgage, but for the mortgage broker to go out and source mortgages specifically under our guidelines. The mortgage broker should be paid for that in cash at a set fee. It should not be a percentage commission. The mortgage broker should be paid a bonus if they reach certain incentives in what the mortgage that you're looking for, and you should pay them. So I would say the simple answer is every single Canadian that owns a home should have a mortgage broker. They should have a personal mortgage broker who is actually a mortgage advisor. On top of that mortgage advisor, you need, as a consumer, to have the set of terms that you're looking to obtain before you talk to them. And the only terms that you're willing to accept are the terms you're asking the mortgage broker to go out and source for you. The mortgage broker then goes out and searches all of the available product from all the available lenders and comes back to you with the offerings that best meet what you wanted to achieve. If they beat what you were asking for, or they meet it, then you pay them a bonus. Don't pay them a commission. Don't go to a mortgage broker and say, "Can you please source me the best mortgage?" And for them to come back with 2 or 3 mortgages. Because what I'll tell you is the industry is built, the mortgage brokerage industry is built on getting the highest commission possible from a lender. They don't disclose those commissions to you, or they hide those commissions. Certainly, if you walk into a bank, all the bank's interested in doing is getting you to pay the highest interest rate possible on their mortgage product. So, simple answer, get a mortgage broker. Second answer, that mortgage broker must be controlled but with some degree of oversight. Now, selfishly, the Wealthy Home Program is built to offer that level of oversight. The wealthy homeowner can receive no income from any mortgage ever placed by one of its members. It can receive 0 income. It's designed that way. The mortgage that they're looking for, what they take to the mortgage broker, they don't pay for. But what they do have is they have a set of terms that are in their best interest that they're asking the mortgage broker to go get for them. And if the mortgage broker gets them, you agree to pay them money.
Is the Bank of Canada buying mortgage bonds?
Sure. Bank of Canada, I know they had the big discussion in the fall about basically bragging about buying mortgage bonds. Look, mortgage bonds are what every single Canadian bank is built on. So if you don't believe mortgage bonds are a good investment, then what you're basically saying is the entire Canadian economy is a house of cards. Now, you'll know that on the House Street shows over the last couple of years, we have been quite honest in how we view things and how we view the housing market's impact on the overall economy. That does not mean that this economy is going to go away. It's going to disappear. We're going to turn into a socialist country. That's not going to happen. What happens is that as a market slows down, people start being proactive in protecting themselves financially. And it takes years for that to happen. But that is a new mindset that comes out. And then on the flip side, on the other end of a housing correction, it also takes years and years before people feel comfortable enough that they start to want to extend credit the same way. So that's how we view things. I can't change my answer. We have 40 years of data that supports it. Anybody can go back and check what we've had to say in the past.
What do you see ahead for the various Canadian real estate markets this year?
Well, what we see in the Canadian real estate markets, I had a discussion with someone yesterday about this topic. All housing markets in Canada function in the same way. So I know everybody has been inundated with this. Real estate is local. Real estate is different from city. It's different in Vancouver than it is in Toronto, than it is in Montreal. It's not, folks. It is exactly the same every place. Families want to own a home. They have a certain level of income, and that level of income will allow them to buy a certain quality of house. That is simply what happens. That happens in Vancouver. It happens in Calgary. It happens in Regina. It happens in Hamilton. It happens the same everywhere in Canada. It is the exact same qualification rules no matter where you go in Canada. Now, in Vancouver, you pay less property tax. So as a result, they'll allow you to borrow more money, spend more money on a house, purchase a higher priced house. So what happens? Vancouver housing prices go up. What we look at though is we look at the home equity pyramid. That's what we call it in-house, the home equity pyramid, or your listeners might refer to it as the property ladder. Well, the property ladder is traveled the same way by every Canadian family for the 40 years that we have data. It is exactly the same pattern. They move in the same pattern. They take on the same amount of mortgage debt. They buy the same amount of home, the same amount of quality of home. It is consistently driven because the infrastructure of homeowning in Canada is the same today as it was in 1990. It hasn't changed. There is a little tweaking that goes on with mortgage interest rates, which impact the amount of mortgage you can borrow. CMHC's rules, which limit how much you can borrow, but it's still virtually the same. Every single change that has taken place since 2008, the last 10 years, with all the mortgage rules changes, all of the OSFI changes, all of the provincial rule changes, every single one of those changes has impacted the housing market exactly as you would expect it to do if you knew how the housing market functioned. So that's what we should be looking at across Canada. There is a consistency in what is going to happen in your marketplace. Where your market was at 2 years ago and 5 years ago and as it is today will determine where it's going to be throughout 2019. The housing markets, the cycles, are different in Vancouver, Victoria, British Columbia, Alberta, Calgary, Ontario, Toronto, Hamilton, or my hometown of Burlington. They're different in Montreal. But the cycles are all exactly the same. They're just happening at different times. Because they're happening at different times, and the rule changes or the interest rate changes that are taking place are happening all at the same time, then depending where you are in the cycle, when that change happens, it's going to impact what happens in the following year, 2 years, 3 years. As we said on the show, throughout the last 2 years, we know where real estate market is going a minimum a year and a half in advance. We pretty much ourselves, we trust our 2-year calculation. These things don't change. You are watching right now in Vancouver, your property tax assessments are out, and you are hearing about declines in single detached houses between 10 and 15%. The property assessments have dropped. We told everybody on the shows years ago that was going to happen. We're measuring the real estate market that far in advance because today's sale, what a home buyer does today in the real estate market will send ripples through that market for the next 2 years. There are consequences to every decision that is being made today. So when a decision is made, when we're seeing sales data come out with in Vancouver today, sake of the argument, Jim, this is Wednesday when we're taping this. We see that back in 2015, sales were 71% higher in 2015 than they were in 2018. There were 71% more sales in Vancouver by members of the Real Estate Board of Greater Vancouver than took place in 2018. You're not going to read that anywhere. So this show will go live in the weekend, days after this report from the Real Estate Board of Greater Vancouver is out, but you're not going to read that sales were 71% greater. We understand that that's exactly what happened. That's why we knew back in 2016 you'd have a 26% house price drop was already recorded. That drop has intensified since our call way back of 2016. The reason why it takes that long, those ripples, to go through the market. What you're seeing now was predetermined 2 years ago. Whether you're in Vancouver, Alberta, Ontario, or Quebec.
Can past real estate collapses predict what we might see in 2019?
Sure. If you measure housing markets the way that we measure housing markets, we are not looking at sales stats from a local real estate board or an organized real estate. We don't care about their commission earnings. That is not our goal. Our goal is to understand how the housing market is functioning. Okay? That is the only thing that we're focused on, because how the market is functioning is going to result in what happens with house prices a year and 2 years from now. So when you hear these stats being released by real estate boards, being commented on by banks, economists, and academics around the globe, we don't care that they don't understand those are commission stats. We're looking at the data behind those stats. And it's that data that drives our forecasts and our predictions and our intelligence in the market. Is that simple enough an answer, Jim?
Absolutely. When a real estate downward trend is in motion, can governments successfully reverse that trend?
Okay, now this is a touchy one. So in the same way that I said that all housing correcting, all periods of house price correction in Canada have followed the exact same pattern, so too I have to remember the summer of 2013, because during the early period of 2013, the first 6 months, by the time we hit May, the housing market was moving into a full contraction. Okay, it had been slowing down. Year-over-year price increases had slowed, and it looked like we were going to move into negative price territory. For us, when we say negative price territory, Jim, that means when the annual pace of price is not keeping up with inflation. That is negative pricing for us. So that was the state in May of 2013. But then the government came out, seeing that. Not the government at first. The first of all was the banks. And what the banks did is the banks quickly dropped their mortgage discounts. So as sales were collapsing, the banks took action to drop their mortgage discounts. Now, that was one time where they were able to turn the market, and everything that has happened from May of 2013 until today is the result of that increase in the mortgage discount. Because what it did is it allowed first-time buyers who couldn't afford to buy a house at the current interest rates to get into the market. And then that started the snowball effect that lasted in Vancouver through early 2016, Toronto early 2017, and is still rolling on in Quebec because that market cycle started later. So could governments reverse it? What the governments can do, Jim, is they could delay the inevitable. Let's say they increase amortizations from 25 years back to 30 years. Let's just say that they went with that scenario, because a lot of sources are coming out saying, well, this is what the Liberals are going to do. Well, let me tell you, folks, if you thought it was bad for the Liberals in British Columbia in your election, and then the Liberals in Ontario during their election with housing markets start being at their peaks, wait till you see what happens to the Liberal government nationally when the national housing market will at that time be reporting over 2 years worth of falling prices. That is a brand new thing. So the government could very well try to do something in an election year to stimulate the economy, because this economy is slowing down, folks. When your housing market is crashing, the way that this housing market is crashing, then the overall economy is being impacted by that slowdown, as we saw in December when the Bank of Canada could not raise interest rates after promising to do so. So they believe they could change it. But what I'll tell your listeners is this. On the way down, a housing market is deflating. And once that deflation reaches a certain point, you've got to wait till it hits the bottom. The government can't come back in and say, oh, we're going to drop interest rates 0.5 point and expect the market to come back. The reason why in this case they can't do that is that there is a point of exhaustion across this country. Even Quebec is already signaled it's starting to slow down, which is the last province to still be in positive territory. When that reaches a critical point, there's no way of reversing it. You just have to wait till it bottoms. And that's what we're into right now. What you are seeing in Vancouver, what we are seeing in Toronto, now, because it's behind Vancouver, remember. Vancouver and British Columbia is just paying catch up for 2017 when those first time buyers were still entering the market because of the $37,000 boost. 2018, that was gone. Your market collapsed. You are now playing catch up with your collapse. Toronto real estate market, they're playing catch up with their collapse. They're just behind Vancouver, but they're all going to collapse the exact same way. So, can the government stop this collapse? The levers are not there. The levers were there in 2013. The levers were there from 2003 right on through till 2013. The levers are not there any longer. They continued to pull all the levers from 2013 till 2016 when that last lever was pulled, and you had a final sales surge in Toronto in the spring of 2017, and boom, it was over overnight. That's exactly how housing markets work, folks. If you blow that bubble up too big, it's going to break. It's not going to deflate.
We'll have more with Ross Kay when This Week in Money returns.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to This Week in Money, we're speaking with Ross Kay. Ross, we're seeing detached homes in West Vancouver and the west side of Vancouver proper selling for 35 and 45% below last year's assessed value. Are these markets likely to see further drops?
What you're going to see now, so those, remember now, when you're talking prices about houses, you're talking about averages. When you're talking to me that those prices have dropped 35 to 40% in some houses, in some markets, the quality of house that we're talking about here is what has radically changed. What happens in a correcting market is the lower quality homes, the teardowns, the houses that nobody would really live in anywhere, that we're selling for astronomical prices. They are the first ones to take a price hit. Now, it generally takes about a year before that price hit shows up in sales stats, but that price hit is inevitable. Then, as the housing correction goes on, higher and higher quality of homes begin to decrease in value until the highest quality of home in the most active price category itself drops. And actually, when those houses are dropping, you know that you're in a housing correction. Although we use actual percentage change to measure a housing correction, what we're really measuring is when are those highest quality of the most sought-after category of house that the current demographic group, overall demographic group in a municipality would be purchasing drops. Because we know at that time we are now into a full-fledged housing crash correction. So what you're seeing in these houses in West Vancouver where they're talking about 25, 40, what you'll see is higher quality homes start to recording these drops. When we recorded the first 26% call that we made in the fall of 2016 on House Street, what we were measuring is we saw the lowest quality of houses were already dropping that 26%. And we knew that within the next year and a half, that 26% drop that we recorded then would be passed through the highest quality homes. Now, we had to wait for that condominium $37,000 boost to get wiped out of the condominium sector, which is gone now. But now that's all playing catch up. So when you see a 35 to 40% drop in the lowest quality homes of the least sought after categories of homes for the demographic group that is active in a marketplace, any municipal marketplace, then you have to assume that sooner or later the best houses will drop to that price. When the best houses drop to that price, Jim, those lowest quality houses have to drop more. Now, you've got to remember, listeners, I hope the listeners remember, the vast majority of the Canadian housing stock is not of that lowest quality. Okay? There are not a lot of teardowns in Canada as a overall percentage of the housing stock. So you have people who are profiteering from the market's downfall, who are grabbing those and they're hoping to renovate them and selling them at higher price. And when you start buying these properties below replacement cost of the land alone, then all of a sudden these properties start to become investable again for builders and small scale developers. These things, these market forces, they are the same on the way up and they're the same on the way down. The last houses to get the highest house price gain are literally the crappiest houses in the neighborhood. Houses that you cannot sell in a regular market unless you discount them heavily. That's what you see. That's what you're seeing today. When you're seeing the biggest drops are in the lowest sought after homes. Those drops sooner or later get passed on to the best homes. So if you're a home buyer, there was 24,000 of them in Vancouver last year with Real Estate Board of Greater Vancouver. What real estate agent in their right mind would tell a young couple to buy an asset, a house, enter a 25-year mortgage that I know was going to drop in price, unless those real estate agents are really that ignorant and they don't understand that housing prices are going to drop. I don't believe people are that stupid. I don't believe those real estate agents do not understand they're selling someone the largest financial asset of their life, financial commitment, and it's going to be worth less by the day they move in. So, your 35 to 40% drop, if this is being recorded in some of the houses, sure, that's going to percolate right on through the top of the market, Jim.
The new assessed values for BC real estate as July 1st have been published by the BC government. As of July 1st, a lot of high-end real estate had huge price drops year over year. Will this affect the psychology of the overall marketplace?
Yeah, a real estate market works on two things, fear and faith. Fear is a far more driving factor than faith is. But when you watch fear take a market, Jim, it is a scary thing to see. Because on the faith side, in other words, I believe housing prices will keep going up, so I'm going to invest in a home. Those are positives. Those are positive feelings. You may fear of missing out. In other words, if I don't buy now, the price is going up. But we look at that as faith. You believe so greatly, so committed that housing prices are going to go up. You're afraid of not buying one now because it's going to be priced out of the market. You're going to be priced out of the market tomorrow. That's faith. That's the positive side. Fear is when you think you're going to lose money. Fear happens when you say, if I don't sell my house today, I'm going to have to take less for it tomorrow. Today's real estate agents, the vast majority of real estate agents in Canada today, I'm talking over 95% of them, don't even know how to counsel a homeowner about undercutting the listing price of their house to beat the market. They have never experienced a housing market where you had to learn the tools that the homeowner could trust you to list their home, which is better than their neighbors, for less money than what their neighbor was asking for theirs. The amount of trust that someone has to have in you as a sales rep who gets paid commission to underprice your home is a very, very, very hard skill to develop. Now, in our case, we were lucky. We had a presence in the marketplace, and we had a history. So when the Ontario housing market of the 90s hit, everybody called us to list their house. We had the ability, because of the sheer volume of our business, to tell homeowners, hey, Joe and Sue, okay, we'll list your house, but we won't list it at $200,000. We'll only list it at $180 because we know it's going to sell for $175. When 5 or 6 other sales agents were telling the people to list it for $200. The people who listened to us sold their houses. The people who didn't listen to us usually called us back 6 to 8 months later to list it anyway at the original lower price. The sad thing is the price had already dropped. Fear. When home buyers fear buying an asset, the largest expense in their lifetime outside of taxes, they quit buying homes. People quit planning to move up the property ladder. We measure homeowner activity in a housing market specifically so we have a lead notice of when the market is going to turn down. You don't see a homeowner activity metric available to the public. We own one. Ours never makes a mistake because we're measuring today's activity to know what's going to happen with activity 3 to 4 months from now. That activity 3 to 4 months from now produces a year and 2-year results. That's what you need to be looking at the market. We're measuring fear and faith with our homeowner activity index, because when people have faith of rising home prices, they want to move up the property ladder. They have faith. When they don't see house prices, or they don't believe house prices are going to drop or rise, they think they're going to drop, fear takes over, and their activity decreases. Every single home buyer in Canada has to follow certain patterns and do certain things that are easily recordable if you know how to track it. We track those activities. Those activities allow us to have our homeowner activity index. So that way we know what trade-up buyers are going to be doing today and in the months ahead. We also measure what the first-time buyers are doing with the market. We know that when they leave the market, what the impact that is going to have on the sale price and house price evolution, and we know what impact that's going to have on sale and sales volume. All of these things are measurable. All of these things are black and white. There is no confusion. Every housing market works exactly the same way.
Is high-end real estate the first to drop in price, thereby causing an anvil-like pressure on the rest of the market?
Good question. So, depending on the amplitude of your cycle, the waves in your cycle, the answer to that question changes. In Vancouver, because the market had gone on for so long, in Toronto, the entire Ontario market, the entire BC market, because that market had gone on so long, the amplitude of the curve in the cycle is so high that the first houses to turn were really just below the highest price houses. Now, your listeners can take this. The top, say 3%. I don't have the exact number in front of me, and it changes from municipality to municipality. There's a certain top percentage. The highest priced homes, they don't count. They're a different part of the housing market. It's the homes just below that I'm referencing when we're talking with as you stated at the start of the question there about higher priced homes. So that just below the about the top 3% of the homes. Those houses there, depending on where the amplitude of the cycle that you're in, the curve of the cycle that you're in, they could move first. They could drop in price first. At other times, when the cycle has not gone as high, the amplitude, the curve has not gone as high, the lower priced homes could be the first ones to cool down. It's far healthier, Jim, I'll tell you, when the lower priced homes cool off first. When the lower priced homes cool off first, you have a normal, regular old slowdown of a real estate market. When the most expensive houses cool off first, you have a problem. You have a market that has run on too long and became exhausted.
Is Japan's real estate market of the late 80s, early 90s comparable to Canada's real estate market right now?
Okay, in terms of being comparable to Canada, now, as I said on House Street regularly, when we talk about the home ownership infrastructure in Vancouver, Victoria, British Columbia, Calgary, Edmonton, Alberta, Ontario, Toronto, every single place in between, and further east. Each one of those markets' infrastructure is a little bit different, and that difference can have big changes in terms of how your housing market functions. There is a massive difference between the Canadian housing market and the American housing market. In Canada, our mortgage payments are not tax deductible. In America, they were. America just pulled one of the levers and they changed the maximum deductibility of their mortgage debt. Americans have 30-year mortgages, Canadians don't. American property taxes are different than Canadian property taxes. Americans have to pay for health care. A family has to pay for health care. When Obama came in and brought out Obamacare, it was mandatory. Whether you got it or not, you still had to pay for it. In Canada, everybody pays through their income taxes. So you can't compare apples to apples because you're not measuring the same apples. Same people, same dreams and goals. We're just regular people, whether we live in the States or we live in Canada. But the markets are not comparable. So when I start to talk about Japan, I would have to spend probably a year studying that market and speaking with professionals from across Japan and to homeowners who have owned in Japan for at least 50 years before I could get enough information to draw an honest comparison between the two. But what I can say is this. Japan went through decades of price stagnation where their real estate did not increase in value. What we're entering into Canada today is the rising portion of the interest rate cycle. We haven't seen that since 1982. We've seen little dips, little ups and downs. That's not the big cycle, folks. The big cycle is the overall annual pace of interest rate change. And that has been going down since 1982. We are now in the upward swing of that cycle. That cycle normally is not that long. When you go back and you look at historical data, it's not that long. This is a historical record, this declining interest rate portion of the cycle. We are now on the upward swing. If that upward swing is in a V, finishes off forming a V on the interest rate chart, then technically we could be 25, 30 years of price stagnation. That's true. And that's what happened in Japan. I don't believe that governments will be able to raise interest rates again, even to late 1980s levels, Jim. I do not believe that opportunity is there. We are probably going to be 30 years or longer before the economies of the world are strong enough, causing enough inflation that governments would be able to raise interest rates to that level to try to constrain growth. You have to talk to experts in that area. I'm not an expert in that area. My expertise is housing and home ownership. That's it. So what I would say in terms of Canada compared to Japan, do I know that 20 or 25 year period of stagnation in Canadian home prices is possible? I would say yes. I would say that if the Bank of Canada had it been able to maintain its goal of even 2 quarter-point rises of interest rates, mortgage interest rates annually over the next 20 years, we would not see house price growth. Now, that's really not a bad thing in many ways, because that would be a slow, steady opportunity for all existing homeowners to do something else with their home equity. Sadly, very, very few take advantage of that opportunity.
Ross, what's the real estate index showing?
Okay, so I would suspect that what this question relates to is back to our home ownership activity index, which measures what the existing 11 million homeowning families that we track are doing in the marketplace. What that index tells me is this. It is at a record low. Now, if your listeners could have the knowledge of how the market functions the way that we do, these things are all readily available in public data. We pull this information from literally over a dozen sources. Yes, we have our own data shipped to us, but that is a small portion of our HOI. We can tell the listeners this, Jim. The amount of inventory that you're going to have to select from this year as a percentage of the overall housing stock at the end of the year will probably be at its lowest total in history as a percentage of the overall housing stock. What the what Vancouver Real Estate Board didn't tell anyone in Vancouver today was, they said sales were down since 2000. Sales were down December as low as 2000. No, they weren't. They were at a historic low. As far back as real estate sales data was collected, the market was at its all-time slowest in December of 2018 in Vancouver. These are inarguable facts. When you quit looking at sales and you start talking about activity, in other words, what are all the homeowners doing this year? Then you understand that what real estate boards have always talked about has got nothing to do with the housing market. They talk about commission sales. That's it. They talk about an infinite share of homeowners each year. Most of the people they're quoting about are failed homeowners. Okay, most of the business. Your listeners who read the report today from the Real Estate Board of Greater Vancouver, they don't know how bad the sales reps in the Real Estate Board of Greater Vancouver were in December. Their level of competence is arguably maybe the lowest in Canadian history. Their sales performance was that bad. You won't see that anywhere. So when we're talking about our activity index, when we're talking about what does it read, we are going to be relying. Most of the talking points that we're going to have in House Street this year, Jim, our members are going to get charts and data addressing these issues so that they can see what we're talking about here. One of our biggest complaints is that, not complaints, but comments is that, well, you give so much information away free on House Street, So our homeownership activity index, we're going to give that to our members, so they can track the market in another new way, and they can chart the market way ahead of what everyone else is doing. And but I can say that index is at a very, very low point right now.
How much paper wealth has disappeared so far in Canada's real estate downturn?
Well, at the national level, if you look at the national level, you're looking at $250 billion. At the national level, you're looking at $250 billion. The way that StatsCan calculates net wealth in Canada. Okay, so the way StatsCan calculates net wealth in Canada, the homeowners that began the year in 2018 are $250 billion poorer at the end of 2018. This is a black and white StatsCan based methodology. We would tell you that it's far greater than that, Jim. In the same way that we would tell you the average selling price of a home in Canada was not $496,000 in November. Why would the average selling price be $496 when the median asking price, so the house that occupied the 50th percent, the house at 50% in Canada, half the houses were worth were asking less than $379,000. If you had $379,000, half of the houses for sale in Canada you could purchase. The other half were more money. Why would you say that the average Canadian home is worth $496,000? Fairnet National Bank says the average Canadian home is worth 600 and some thousand. Royal LePage says the average Canadian home is worth 607,000, but they quote median. Well, if the median home is worth that much money, how come you can buy half of them for only 379,000? We just measure housing markets different, Jim. We measure the housing stock different. The reason we have to make all these measurements is simply because when you're giving advice to people who plan on spending hundreds of thousands of dollars and they are going to commit to 25 years of mortgage payments, you need to tell them what's going on with the market so when the prices drop, they can have made plans to deal with that. If they want to wait for prices to drop before they buy, they can wait. If they want to accept what any kind of loss in their home's value before that they purchase, they can make that choice. The choice is theirs. I personally don't think there's anything wrong with my house dropping $10,000 in value. I think that is a great investment for my family, for the lifestyle that I live, by not having to move. That is my belief. Everybody's belief is different. Net wealth is a different story. That is a black and white calculation. Using Statistics Canada's calculation methodology, Canadians had lost $250 billion of housing wealth, homeownership wealth, in 2018. Using our numbers, it's over $500 billion. Two ways of looking at the same question. One uses a government methodology. The other one uses a factual market-driven methodology. The fact of the matter is, if the stock market had dropped that much, if stock investors had lost that much money, it would be headline news across the country.
Ross, how can people find out about all this nifty stuff inside the wealthy homeowner?
Well, the wealthy homeowner is a membership-driven service. Every single member gets access to the same type of information at their own that is relevant to their own specific situation. It is there is a sign-up fee, which is allows them to get a dashboard created. Then there is a ongoing monthly fee that is a joke. It is so low. The information that we have provided on Howe Street, anyone who wants to say whether or not this is worthwhile, whether or not what we're saying here is the truth, all they have to do is go back and look at 2 years' worth of shows on Howe Street. They're all stored. I am proud to say you can go back and listen to any episode where we forecasted something, because every single one of those forecasts came true a year or 2 years later. We made a call back in May telling people the housing market had dropped to a point where gold was going to start increasing in value. People said, what the heck is this guy talking about? Gold's going to start increasing in value. We know that watching 40 years worth of housing data, every single housing correction, gold shoots up in price at that moment in time, within a month or 2 months. What happened this time? I think in June, gold prices started going up. And I think gold's gone up substantially in the last 6 months. I don't know. I haven't checked, but I heard that on the news. The reason why I haven't checked is because I know that's what happens. These sort of things are what you get as a member of the wealthy homeowner. It is simply an invaluable service that I believe every Canadian homeowner should access. And I'll tell you, there are people that in the last 2 years are over $250,000 richer because they paid a little tiny $9 a month membership fee to get advice. $250,000. There are other people that are millions of dollars richer today. Those were the people who were going to buy in West Howe Sound. Those were people who were going to buy in Kitsilano. There are some members in those marketplaces who are over $2 million wealthier today because they didn't lose $2 million by buying into the housing market in 2015 and 2016. Go to www.thewealthyhomeowner.ca and sign up. You've got to pass the test. There is a profile that you have to fill out. If your answers to the profile come back in a manner that means you're going to your odds of enacting wealthy homeowner strategies are high, you'll be accepted into the program. If your answers come back that it appears you're probably not going to implement the strategies, meaning you're probably going to fail, then you're not going to even be allowed access to the program. Last year, 53% of applicants were denied. 47% were accepted. That is how much we focus on success. We have no desire with this program, any desire at all, to have anyone lose any money based on our advice. Even in a correcting housing market, a regular homeowner can make money. I'll leave the listeners with this today, Jim. How many listeners today who own a home on January the 2nd went out and wrote a check from their home equity line of credit to fill up their TFSA? The $6,000 that is available to be invested in their TFSA in 2019. How many of your listeners did that? That's what every single homeowner in Canada should have done on January the 2nd. No matter if you're a first-time buyer, a last-time buyer, or if your house was losing money. You should have written that check off your home equity line of credit. You should have gone into your financial advisor, give them a set of rules that you want them to follow, and invested that $6,000. Because 25 years from now, if Canada does go through a period of stagnation in their house prices, that money that you've invested in your TFSA is just like you invested it in your house. You get it tax-free. There is no capital gain. Talk to a financial advisor. Don't listen to me. Don't believe me. Talk to a financial advisor if that's a good idea. If the financial advisor says, oh yeah, that's a good idea, then you should sign up for the Wealthy Homeowner, because we can tell you what instructions to give your financial advisor, and we can let you track your home's value over the next 40 years so you never have to worry.
Ross, thank you so much for being on This Week in Money.
And thanks for having me on, Jim.
My guest has been homeownership consultant Ross Kay from thewealthyhomeowner.ca. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Victor Adair, Ross Kay, and thank you for listening. If you have any questions for the show or for our guests, you can send them to info@howestreet.com. Now stand by for a company showcase update from American Manganese CEO and President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Happy New Year and welcome back to the show, Larry.
Well, a Happy New Year to you, Jim.
Larry, some good news. Your pilot plant is finally in the working stages or starting to get that way. What can you tell us about the development?
Well, I just got back a half an hour ago from looking at the plant with the CEO from Cometco and the contracting company that's building the plant out, and it's pretty. Looking at the drawings and everything, that's very sophisticated. And we would hope that, I know that there's been delays, most of it through that screen, which we'll get everybody a picture of. But it'll probably be liquid tested in about a week from today, or if not that, the following Monday. And then we're ready to go. That's phase 1 and 2. You got to remember that this is the new technology that we'll be patenting, and that technology is allowing us to take the scraps that are adhered to aluminum foil and getting rid of the glues and everything else, and the foil prior to putting it through our leach plant. So I know that it seems like this has taken longer than we first anticipated, but it's a lot more. It's a lot more complicated than the pilot plant we did for manganese, for example. And it's a very robust plant, So I'm got my fingers crossed that we can do, 10 to 30 times as much material an hour as we're talking about, and we're talking about 1 kilogram once it's up and running. So that'll make up for a lot of lost time, and I'm happy with the progress so far. We want to make sure it's done correctly, that everything is working top-notch, and before we commission it, but we will be commissioning it for liquid testing, in that period of time I just talked about. Now, we've attached an article on the podcast that has to do with the electric car, the dream translating into reality. And what I found interesting about that is that back in 1900, electric cars made up 28% of total car sales in the U.S. And Henry Ford came out in 1920 with the mass production of combustion cars, and over the next decade, the electric cars pretty much disappeared from the scene. But history always seems to have a way of repeating itself, and now I think after that small burp in the late 70s when they were building electric cars, that now we're definitely on track to see more electric cars out there than, let's say, gas guzzlers sales, and probably within the next 2 decades. At least they're talking about 25 million in the next by 2025. So there is a. But anyway, you get the gist of what I'm saying is that electric cars are coming back, and I think that's most important to our business, which is going to be recycling those batteries. And I still see articles where they say with the drop in the expensive materials in a lithium-ion battery being mostly cobalt, that they're not lucrative. But we've done some calculations in here, and 811, which is the lowest chemistry out there for cobalt, has a value on a 1,000 kilogram battery on a 100 kilowatt hour battery, has a value of $1,500, and that's a half a ton. So a ton would be roughly $3,000. So you look at the price of gold today, and that equates to 2.3 ounces of gold per ton. And I know that any miner out there would be happy to have a surface mine that was running 2.3 ounces a ton. They'd make nothing but money. And we don't have gold, but we do have the cathode materials that have the same value as 2.3 ounces a ton for gold. And that is exciting when you stop and think about it. We've pretty much broke the record on getting our patent forwarded. We've been able to come up with a process to get the material off of the cathode material off of the foils, the aluminum foils, and we've got a patent-proven project out there. And our costs are going to be minuscule compared to a gold mining operation. So, I think you can do the math on that and realize that we're going in the right direction. And anybody that's looking at recycling is, being attracted by those same numbers I just gave out. So it's been a slow time this week. A lot of people not back to work yet. This is what we're finding, and but we're looking forward to the year. I mean, the Dow's up significantly today. NASDAQ, S&P, Venture, all up. That's great, and we're trading at a decent price, up a little. Last I looked, and so I see nothing but a good year coming, and I think this is our year to shine.
Larry, where are you traded, and how can people get more information about American Manganese?
Well, we're traded on the TSX Venture Exchange, and that is under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. We're traded in Frankfurt under the symbol 2AM. You can visit our website where everything that we talk about is on there, and that's at AmericanManganeseInc.com. You can phone the company at 778-574-4444. You can email me at LREAUGH@AMYMN.com, and we'll be happy to answer any questions you have.
Larry, thanks a lot.
Thanks, Jim.
We've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on January 4th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.